Well, welcome everybody to today's episode of Bricklet Buzz Live. I'm Ray Jordan, one of your hosts, and I'm with my co-host, Matt Brown.
Hey guys.
So today, what are we chatting about, mate?
Mate, big topic. We're going to tackle depreciation.
The power of depreciation.
Yeah, so obviously, well, maybe not obviously to everyone, but depreciation is a big part of a decision as you're building out a investment portfolio, because it's one of the main tax deductions that are available to property investors. So, mate, what is your understanding of depreciation?
Well, depreciation, simply for me, is when something goes down in value.
Correct. But when we're investing, don't we want it to go up?
Well, that's, I guess, the goal. But I think that's part of the understanding of when we're looking at a property, what makes up the whole property investment, because you've got the land component and then you've got the things on top of the land itself.
Correct. And then, so what a lot of people don't realize is it's actually the land component of an investment property, which is going to be increasing in value. And the building and the fixtures and fittings are what are actually depreciating. And because they're going down in value, they need ongoing repairs and maintenance. The government, or the ATO, allows you to get a tax deduction for those. And today we've got a very special guest, Brad Bear from BMT, who will be jumping on shortly.
Are you on there, Brad?
I am. Can you hear me?
Yeah, we got you loud and clear, mate.
Great.
Thanks for joining us today.
Always a pleasure.
I think your video on, champion?
There we go. I don't have an option for video.
Well, while we're
gotta
working,
love technology.
We're having a great time with that, aren't we?
While we're working on Brad's video, he is a very good-looking man, so I definitely want to see him.
You try it now, Brad, because I've just promoted you to an actual panelist.
And this is another really important thing. When you start anything in life, it doesn't have to be.
I'm here.
So one of the key things is, if you wait to make sure that everything is perfect before you launch a new business, try a new skill, or take on any new endeavor, you will never start anything. And I have tried to adhere to this rule myself to just get started. So please be patient. From time to time, we will have technical issues, but we'll always start at 12:30. You may or may not be able to see us. You may or not be able to hear us, but we will be here. Yep. So let's start that again. Brad, mate, thanks for jumping on. Do you want to tell us a little bit about BMT, how it all got started, and then yourself, mate?
Yeah, absolutely. And I heard your little rundown on depreciation there a moment ago. I was pretty impressed, Matt. You've been listening to me or something. Look, BMT, how it started. Look, well, I've been around since 1997, and I've been here since 98. So I've got over 20 years playing in this game at BMT. I was actually the first staff member under the guys that started the business. So we worked out of a spare room, and I was still at uni being lectured by one of the owners. I came on with them, joined as their partner in 2002. We've grown to do, we're quantity surveyors, we do depreciation schedules, and we've grown from that to a little under 200 staff organically, and do these things all over the country. We've done about 750,000 depreciation schedules in our business.
So you should be good at them by now, Brad.
Yeah, we should. Look, if there's a mistake being made, we should have made it by now. We should be able to get them right. But so we've done a lot of them, and we're spread all over the country. We probably do half of them, the market share roughly in the country of them, I think. And look, so it's been a great journey. I've gone from a little spare room to run a business with a couple hundred people, and it's been very interesting.
Whereabouts are you based, Brad?
Look, we're national. I kind of half live between Sydney and Newcastle. We started out in Newcastle, so I kind of live between the two, or I used to, until they locked Sydney down for all this time, although we're all on lockdown in the whole of New South Wales at the moment. So, but I travel a lot between the offices, but spend most of my time between those two, because So Newcastle's the biggest office. It's been there. It's where we started. It probably holds over half our staff all of the time. and the rest, but they're all staff everywhere that do everything. But that was the base originally.
And you actually live in Newcastle?
Yeah, when I can. In between the two, here and Sydney.
How's the market up in Newcastle?
Oh, it's been flying. I'm a keen property investor. A lot of my properties are around Newcastle, which has been great for the growth over the last little while. And I've been trying to help some different family or whatever to get into property over a little while, and I have a look and give an opinion. And I keep getting shocked by the prices. I even tried to buy a couple of things a little while ago, and it doesn't seem to be slowing. There's a bit less on the market right now because of lockdowns, I think, but the prices are I'm just so surprised. I get vales and I'm happy because I own properties. I'm a keeper.
If you're in the property markets,
but
it's good.
It's been flying along up here, which is great.
Well, today we're going to be talking about the power of depreciation, and I think Matt, aka Nutty Professor, is going to be, asking a lot of questions. So I'm going to kind of just let you steer this, Matt.
Great. So Brad, mate, you heard my explanation of depreciation, but I'll hand it over to the professional. And mate, so what is depreciation, and how is it interpreted when it comes to an investment property?
Look, Matt, yours is pretty good. I think
was it Matt or was it me?
and you hit one of the nails on the head there with people are saying, like, my properties are supposed to go up in value, right? They should appreciate. But the things in the property do wear out. So, I think the easiest way to explain what is depreciation is probably compare it to a car. We know, we buy it, it's new, we drive it out, suddenly it depreciates by a heap in a very short time. The concept is that the value goes down. In your investment property, your bricks and mortar wear out one day, just like your car, they last a bit longer. Your carpets, your hot water service, your air conditioning systems, these are all working items of stuff, everything from the building to whatever it is that decline in value or depreciate over time like your car does. And they might not depreciate from a how much you can sell the property perspective because the property itself goes up, but your carpet wears out and you've got to throw it away one day. The tax office says if you use that property as an investment property, you can claim a deduction for that decline in value or wear and tear. Thing about it is it's a non-cash deduction, so you don't pay it out each year. So it makes a pretty big difference to the cost of owning an investment property or the after-tax returns when owning investment properties.
Yeah, I definitely think a lot of, novice property investors really look at tax deductions through negative gearing, as opposed to really thinking about the depreciation of the asset that they're buying. And then so negative gearing is when you're making a cash flow loss on that property. The income that property is generating for you is not enough to pay for all the expenses. So that means you've got a negative cash flow, negative gearing. And then they use the depreciation to try and sort of offset that at times. But there's two big different ways that you can get a tax deductions through that. My preferred way is to have cash flow positive properties that have strong depreciation. So the positive income that I'm earning from my investment portfolio, I'm not paying any taxes on those because the depreciation is offsetting that income. Is that your understanding, Brad?
So yes, look, whether the property starts as a positive cash flow property or a negative cash flow property, after depreciation with the positive properties you're talking about there, rather than having to pay tax on that positive income, it creates a deduction where you don't pay tax on that income. If it's already a negative cash flow property, what we do creates another tax deduction, which hopefully after that additional non-cash tax deduction, sometimes and quite often turns that property from a negatively geared property, a negative cash flow property into a positively geared property after you get a tax return. So it can, the term negative cash flow versus negative gearing and positive cash flow versus positive gearing, they're two different meanings. And one is what's before and what's after. We create a deduction that makes a difference and can turn it from a negative cash flow to a positively geared property afterwards. Or you just don't pay tax on that income. Because if you've got a positive cash flow property where the expenses are less than the rent that you get, you're actually making it income. You have to add that to your other income and pay tax on it at whatever your marginal rate is.
So before we get to depreciation, what other expenses, when you're talking about a negative cash flow property, what other normal expenses can a property investor expect when owning a property investment before we start looking at claiming the depreciation part?
Yeah. So I guess the biggest expense that you have is interest costs. They're typically going to be the biggest expense that you have when you're buying any type of property, because you need to have most people need to have a loan to buy or leverage into those particular properties. Then after that, you've got the day-to-day running costs of that particular property. So you've got property management fees, if it's a unit, strata fees, you've got insurances on the building itself, and also as a landlord. You've got rates, so like water rates, council rates. If you're over the land tax threshold, then you've also got to pay some annual land taxes as well. Brad, have I missed anything?
I think you've got that pretty close. Maintenance, repairs, I think we got those. And interest, yes, is your biggest deduction. Depreciation is your second biggest deduction. And a lot of those, obviously, the rest of those add up. So there's a few costs in there.
Yeah, there is. Yeah, so those are the expenses of having of owning that investment property. So then looking at and everything that you spend money on an investment is a tax deduction off your income and also the income that the investment is actually producing. And then so now looking at this non-tax deduction, mate, if we're talking about tax deductions, why are there quantity surveyors? Why can't my accountant just put it in my tax return?
And look, the accountants are our friends. We work alongside them. We just do a specific part, which is and the reason we get there. So I'm not an accountant. I'm a quantity surveyor. So we actually traditionally count bricks and estimate construction costs of buildings. So almost as boring as accounting, or maybe more. So after 4 years of degree, I get a set of plans and I measure it up and I colour it in with pencils and count the bricks. It's great. Anyway, so traditionally we are someone who we might work for someone in the construction process anywhere. How much does it cost to build? How many bricks do you need to buy in order to build it, etc.? So the claims you make for depreciation have a relationship not to the purchase price, but they have a relationship to the construction cost and the value of items in there. So the science for us is actually making sure we put a construction cost on it that's correct. And the tax office will actually accept the estimates done for the purpose of this by a relevant professional such as a quantity surveyor, is their words, because that's what we know how to do. We then marry that up, obviously, with the tax rules to help to maximize those deductions. We need to know what we can and can't do, but it's a compliance piece around making sure, and that's where the accountant doesn't do it. They know how to how to apply depreciation, but they've got to apply it to something. We come up with those numbers to apply it to. We actually apply it as well, but we do a little piece of that tax return with all the rest of those claims that exist there.
Okay, and then so I think most people have heard of a depreciation schedule. So what's included in a depreciation schedule? Yeah, sure.
Look, and let's not get too technical on it. There's two parts you claim. One's against the structure of the building. It's 2.5% per year of the cost of building it. That's the hard stuff: concrete, floors, walls, and roof. Those things that last a long time, you get a claim for 40 years. So you need a cost against that. You need how much to claim against that, obviously. So the other part, we get to claims around plant and equipment, depending on some changes and things. But carpet, hot water service, stoves, blinds, curtains. These things don't last as long and they depreciate quicker, like your car. Bricks hang around for a while, so you get to claim them over 40 years. Carpet, stoves, hot water services, 8 years, 10 years, 12 years. They put what the life expectancy is on those things, and we get to claim them over that time. So we need to put costs on those things. We need to make sure that we apply whatever rates applicable, help to maximize those deductions. Other things, common areas, you own part of the common parts. So you need to make sure they're included. That lift is a fairly expensive item, plant item. Want to find that one. Underground car park, another expensive item. So you get to claim all your bits of those. So you need to make sure they're also included in them.
So you were saying, Brad, there's a difference between the structural, like the building itself, the physical walls, the doors, the roof, all of that. And for an example, let's just say you estimated the cost of that structural work was, say, $100,000. And you're saying that you can claim 2.5% of that $100,000 over a 40-year period?
Correct. So if it's brand new, $2,500 per year, 40 years, you can build me a house for $100,000. That'd be nice.
I'll have two.
Okay, I was referring to a granny. I was referring to a granny flat.
But yes, 100,000 is an easy number to play with.
Yeah,
So it's 2.5% each year. Now, that in order to claim that, it needs to be built after 1987 if it's a residential property. So if it's brand new, $100,000, $2,500 per year for 40 years. If it's 10 years old and it costs $100,000, you buy it now, you've got 30 years left, $2,500 per year for the rest of the time. That claim also applies to some renovations as well. So if someone, added another room to a really old house and put a new kitchen in 5 years ago, then you can claim that building allowance component on those things as well. So applies to the actual original property and if the date's right, and can to some renovations as well, apply to some renovations as well.
Okay, and then the second, sorry, Matt, and then the second part was the plant and equipment. Now, there's obviously varying degrees of the period of time that you would depreciate that over.
Yes, and look, the tax office gives us a list of how long they think everything should last. There's about, we built an app, it's all on there, that's easy. There's about 180, 170 something items in a residential property that have a life. Most of them are sort of 8 years or 10 years or 12 years. And that correlates back to coming up with the percentage. Now, these things, look, in order to claim them now, due to some changes a few years ago, you can claim them if they're new. You can claim them if you buy them yourself and put them in your investment property. But since May 2017, you can't claim them if you buy them secondhand in a property or buy them secondhand. The answer is if they're previously used. So a pretty big change back in 2017. Usually, and it makes sense that my 2-year-old stove is still worth something, but our friends in Canberra make some interesting rules sometimes, and this is one of them. Suddenly, when you buy a 2-year-old stove, they say it's worth nothing for depreciation. But they put a life on these things. The old property still gets some deductions, but they don't get them against that plant and equipment anymore.
Okay, so all the plant and equipment that falls within that definition, if you haven't bought it, can you tell us, what do you mean by new then?
So if you buy a brand new property, obviously it's all new. If you have an old property and you put a new stove in it, you can claim for that new stove. If a developer has owned that property and not been able to sell it and rented it out for up to 6 months is the amount of time, and then you buy it, it's still seen as new for the purpose of you, as long as the developer didn't claim depreciation. So that's the new versus secondhand. Commercial properties, by the way, are excluded from this situation. It's only on residential properties only. You claim it on both. The rules didn't change with those. So that's the new versus secondhand.
And new also works if you're an owner builder. So if you buy an old house as an investment property, you knock that property down, and then you build a completely new house yourself. So long as you then rent that out, you can then claim both sides of that depreciation yourself.
Absolutely, because you are the first owner. You're not using. See, the one that gets caught up here is if you live in the property yourself first. If you buy it new and then you live in it for a period of time or any amount of time, then you move out of it. The time you rent it out, even though it was yours before, it's seen as secondhand. So you still get, on a secondhand property, you still get that building allowance component, which is 85 to 90% of the amount of total claims on a property. But that plant is affected. As soon as it's used, it's seen as used. If you're the builder and you put it there and you don't live in it and you rent it out straight away, absolutely you get to claim it.
And so like you said before though, Brad, coming back to Matt's example, if I buy a house and then I renovate it, I do some building extensions, that new building aspect, I can depreciate over that, the structural side of things over that 40-year period. And as part of my renovations, I put in a brand new kitchen, new carpet, new dishwasher, new whatever. I can claim that under the plant and equipment depreciation.
Absolutely. Just don't move into it.
Don't move into it. Okay. Yeah.
So when should an investor be looking at getting a depreciation schedule? Is this something to be doing just at tax time?
Look, I think I mean, the first thing I am a pretty firm believer in is crunching your numbers before you buy something. And you don't actually need to buy a depreciation schedule then. There's calculators we got for free that give you an indication, right? So the first time to think about it is, like we talked about the expenses, positive geared, negative geared, and those things, which, Matt, I'm sure you go through with these guys a lot more. You need to crunch these numbers before you buy something. One of the numbers in there that makes a difference is how much depreciation is there for me, with my tax rates and all those things, and what's it going to cost me to own that property? Look, after that, once you obviously buy the property, that's the time to think about, I want some deductions. Usually when you're looking at a tax return is the time to think about that in detail. Pre-30 June, things are claimable as like our costs are claimable then straight away instead of next year. The other time is really when you the other thing there is if you want to adjust your tax through the year with a PAYG certificate, that's a time to consider where you can have some less tax potentially taken out of your income through the year by your employer. You can actually see your accountant and do this, so you get the tax back on a fortnightly basis instead of a big whack at the end of the year. The other time would be if I'm a renovator. If I'm looking to renovate properties, then you're obviously adding things, so you're adding more stuff to claim. But before you rip it apart is an important part. We've called this scrapping. It's not the tax office approved word necessarily, but an easy way to understand it is call it scrapping. When you renovate, you rip things out, you throw them away. If they've got some tax value left at that time, rather than just throwing them away, whatever tax value is left is potentially an instant deduction in the year when you do that renovation. So, if we think about the times to think about depreciation, before you rip it apart, before you throw the stuff away that has value, talk to us, make sure there's a schedule in place of those things that are there. So when you throw them away, there might be a pretty solid instant deduction right then.
Okay, so in summary there, we should be getting a depreciation as soon as we turn it into an investment property. So if I'm buying a property brand new, the best time to probably do it is before the tenant moves in so get that depreciation schedule or get the quantity survey in to do all the reporting, the testing. So what do they actually do on site? Because they have to actually go to the property, yeah?
Yeah, look, we visit the property in order to, and we want to identify as much of that plant and equipment as possible, so we get the most deductions. The more stuff we find that you can claim faster, the more money you get, right? It's quite simple. The other thing is to estimate the construction cost of your flash, granite benchtop, etc. We want to see it. We want to find everything that we can there. And when we're there, we go through, we measure up. I don't actually count the bricks on site because that could take a while. We measure everything up. We put values on everything, and we like to do an inspection all the time. It's a little hard, shutdowns and COVID, they're a little slow at the moment because we can't come to people's houses. But to do it properly, we want to get through, inspect that properly. From there, we estimate, we put values on things and prepare that schedule, and just it's got some numbers on the bottom that you use in your tax return each year, basically. So try to make that, the process otherwise fairly simple. People, with the address of the property, I can see a fair bit of data these days. So we can usually see what you paid for it when you bought it and some of that stuff, some photos on the portal from when you rented it out, etc. But we go through and find out, put together a report to give to you and the accountant to save some money. It's the plan.
So I guess my takeaway on all of that is, and I've heard you say this before, Matt, that when you go into any type of investment, you really want to do your numbers, educate yourself, understand exactly what this investment is going to cost me, what I think I'm going to get out of it. And part of that is, and Brad, you mentioned your calculator, and we'll include it in our show notes, that even before you buy the property, you can actually do a bit of an estimate to see what the overall position is going to be with regard to this particular investment. And then you're arming yourself with good information, the right information to make an informed decision on that investment. Once you've secured that property, you then go through the process of formally documenting that QS report or the depreciation schedule so that you can include that in your annual tax return, or as you said before, Brad, even speak to your accountant about implementing that rather than getting a big hit at the end of the financial year, having a bit of a tax break on the way through during your salary.
Yeah, Good summary, absolutely. And look, some people like a hit at the end of the year. It's a forced saving. Some people, I don't know, I'd like my money as soon as I can get it, usually.
Yeah. And so how does this work? Sorry, how does this work then when it comes to bricklets?
Oh, you literally took the
Property fragments.
question
Yes.
out of me. So Brett, I guess when it comes to an entire property, now we've got a thorough understanding that there's two parts of depreciation. So how does that work now if we fragment that particular property into 100 bricklets? How does it impact each individual bricklet owner?
Yeah, well, look, so I mean, it's like in the common areas, you get to own or claim for your piece of it, right? And that's, the simplistic answer is that. But when we drill in that to a little more detail, it gets a little bit better. And I've done some numbers with that, Matt, so we could see what happens. And so with that building component, what all it means is that if you own a percentage of that property, you just get your percentage of those deductions, right? So that's great. That works quite well. That's fine. But with the plant and equipment, it actually works out a little better because of the style of ownership. What we get to do is actually split the value of the item that you have in that property. And then some of the rules with depreciation on these things mean that if they're worth not very much, as in they're cheap or less than $300 an item, you usually can claim them at 100% in the first year. Now, when you buy a property with a nice stove in it that's worth $1,500, you get to apply or claim it over its effective life, which might be, depending on the rule, when you bought it, 8 or 10 years. But if you only own a little tiny piece of that stove, less than $300 of that stove, you get to write it off straight away in the year that you bought it. So when you just buy a little piece like this, if the ownership structure is right, then you actually get to write off straight away. So what it means is if you own one bricklet in a property, the amount you get to claim in comparison to what you paid for that bricklet as a percentage is a lot higher in that first year, giving you an instant bit of a kicker in claims. Obviously, you get to claim the rest of it over time, but that little kicker actually works out pretty good. So you get some additional, and when do you want the deductions? Straight away. I want my money now. Sorry, I'm an X2 generation, but I still want it now. And I want it now because I want to put my money back into offset accounts and use it, as opposed to I just need to spend it on everything all the time. But it does give you that kicker at the start, which is the most important time usually with an investment property, because that's when you've outlaid the cost, the rent hasn't increased yet. It's probably the most expensive year. So let's get the most deductions as soon as we can.
Yeah, I'm definitely all for getting tax variation forms completed, getting that income coming back to us in your pay cycle, whether that be weekly, fortnightly, or monthly. And that's going to really improve your spending plan position so you can funnel more of that surplus cash flow, because hopefully it increases that surplus cash flow into more investments now. If you don't get that money and you leave it with the government, they're going to pay it back to you in 12 or 18 months' time whenever you do your tax return, but they don't pay you any interest on that. Whereas if you get that money straight away, you can either have that sitting off your home loan or off your investment loan, or you can have that going into many different places to increase your net wealth.
I 100%. Look, the two pieces are, firstly, let's get it all right. We go through, inspect properties properly, maximize that deduction. That's my only piece of this whole part of the property piece, is actually go get that right, get as much as you can, and then, don't leave more with those blokes in Canberra than you need to, and get it off them as soon as you can, because I don't like the way they spend it sometimes, I think I'm better at using it sometimes.
So coming back to the bricklet analogy, do you have a sort of some numbers there that you've already crunched, and then the difference that it's going to make on a certain sort of bricklet price?
Yeah, look, and I did a couple of those, and I found that, I took one that was a $600,000 property with 30 owners. Mm-hmm. So you're buying in at $20,000 for one bricklet. And look, the deductions for that one bricklet, when you've paid $20,000, worked out at just over $1,280 in the first year, which is about 6.4% of your actual purchase price. Now, remember, depreciation doesn't necessarily relate to purchase price. It's about construction cost, but this is how the numbers come out in this scenario. On that same property, for the whole property, it had deductions on the $600,000, if I owned one of it, of about, in the first year, $14,800. That's 2.48% of the purchase price as a deduction. So 2.48 or 6.4% in the first year of deductions, which is where that one bricklet actually had a much more of a percentage of your purchase price as a deduction in the first year. You know, $1,200 is not going to set the world on fire, but you only paid $20,000. Okay, yeah. So you only get the portion that you're supposed to. So first year works out all right. Look, the first 5 years, you know, nearly 13% of your purchase price is your claims in one bricklet. And it's only about just over 10%, 10.7, sorry, percent of your purchase price claims over 5 years with that, if you had to own the whole property. So more deductions early years as a percentage. And you've got to sort of think, well, maybe should I have 10 bricklets in 10 different properties because I get more deductions at the start as the, you know, with the same amount of money. We had another scenario. It's $1 million property with 40 bricklets. One bricklet in the first year is about $1,300 in deductions, or 5.2% of your purchase price of $25,000. If you had bought the whole $1 million property, your first year deductions just over $21,000, or about 2.19%. So sort of 2.5 times deduction in that first year that you got than you would have got if you had, as a percentage, you know, pump that all into one property. Preface this with depreciation is only one piece of all these numbers, but when we talk about that depreciation bit, it's higher in this situation because of the way we get to split those assets and claim those things, you know, quicker in those early years, or write them off so much at the start. There's that 100% of things when they get worth less than $300. There's also another thing called low value pooling that gets more on things less than $1,000. That's another thing that adds to that deductions. It also helps that deduction early, helps in the second years, but we just apply the appropriate rules, and the small percentage ownership helps to do that. We apply these same type rules where we split a schedule for someone that buys 30% of a property or 50% of a property. The difference with that is not many items. Your $1,800 stove doesn't get below $300, right, when you own 50% of it, but it does when you own such a small percentage of it. So the numbers look, you know, depreciation numbers at the start look good, so that's good.
Fantastic. So what that means for bricklet purchases is our on cost is typically around 6%, because you've got some conveyancing and you've also got stamp duty that you need to pay when you're purchasing a bricklet. So that's quite interesting to know that even though they're taxes that you're spending in that first year, you're pretty much getting all of that back as a tax deduction in that first year of owning a bricklet if you are the first owner, which, yeah, that I did not know until you just informed us. And that's why we get smarter people than us on this show to explain complicated things.
Sorry for all the numbers there, but yeah, look, you're 6%. So those two scenarios, the first year claim, 5.2 and 6.4% on those was the amount of the purchase price that was a tax deduction for depreciation. So yeah, it seemed to correlate out to a fairly similar number, which was lucky.
Interesting. Yeah, I'll actually work with you and some of our vendors who are listing property onto the Bricklet platform and just see how we can get the Bricklet price to be the most tax effective when we actually list those on. So that'll be another bow in my quiver when we're looking at trying to maximize the potential for these investments for these investors.
I'll leave that to you, Nutty Professor.
Thanks, buddy. And so, Brad, is there anything else that with depreciation schedules that we sort of haven't thought about that you'd want to share with the community?
Look, the one thing I'd probably add, and probably given the time of year especially, is purchasing bricklets, purchasing properties. Lots of people have existing properties, and about 70 or 80% of people don't take advantage of this deduction properly. Like the tax office figures, and I think our newsletters with this scenario is going out today. You might receive one by email today, Matt. We compare the figures that the tax office actually has for depreciation against each property investor versus the average that we have claimed in our reports. And there's a big difference. So we find that about 70 or 80% of people aren't maximising the deduction properly. And you can actually go back for 2 years if you've been missing out. So you can amend two tax returns. And if you've been claiming nothing, or you've been claiming half as much as you should, then you can actually, get some of that money back out of Canberra. A bit like you said before, if you don't pay your tax, they'll find you. The bank will take the property off if you don't pay the interest. If you don't make your tax deductions, the tax office doesn't care. They let you keep going on your merry way. You can go back and ask them for 2 years back. Don't do another tax return and miss out another year, because if you've owned a property for 4 years, you can't go back 4 years, you can go back 2. If you wait another year, you can only go back 2. It's pretty easy to work out what sort of deductions should be there. The calculators on the sites are free, or you can talk to us about the property and we'll give you an indication of what deductions should be there. Don't let the tax office keep all your money. That's probably the last thing I'll say.
Great. And then, so mate, on a personal note, you're quite an avid property investor yourself, and you've had a bit of a poke around about Bricklet, as I sort of introduced this to you a week or so ago when I sort of said, hey, mate, I need some info on depreciation. Mate, what do you think about Bricklets as sort of an opportunity for people to get into the investment game?
Well, the thing is, it's pretty hard to get in right at the moment. If you're not in, the deposits required, the cash you need to do that it makes it tough. If you can't get in and do something, or for whatever reason you want to diversify, you don't need as much capital to do this. You can do this. It's like people can invest in the share market with, I don't know, $10 probably, a small amount of money. You can't go and buy property with 25 grand. If you save $25,000, you're not paying stamp duty on hardly anything in this country at the moment, let alone actually having a deposit to get to anything. So as a concept of being able to buy, and like I'm an avid property investor. I love property, love talking about property. I've done lots of renovating and buying property and developed some small property. I like to hold property. It's good, it's been great. I've learned lots about that in all my years at BMT. But without some sort of savings or some sort of injection at the start, you can't start. If you've got some sort of like fractional investment like this, you can actually start. You only get your portion of it. But the benefits of property investment are something you can take some advantage of based on how much money you have. Without actually, the big thing to me is you've got an opportunity to invest in property where you don't really have enough money to do it yourself. And that's, and having a platform to be able to do that, that's not, can I find someone who can and go 50% with them? All those things have got hairs on them because you're going into partners, kids get married and they want another house, want to sell it. You can't sell bits of it. You can't sell half a property normally. So it gives, to me, that it just gives the opportunity for someone to get in, which I think is great.
Terrific.
Yeah, fantastic. Did you have anything else that you wanted to add onto that?
No, I'm going to go away and digest a lot of what I've heard today, what I've learned, have a better understanding of depreciation, especially how we can actually work with Bricklet. And I've learned a lot today. Very valuable information. Really appreciate the insight and the learnings around it, Brad.
That's great. Great to be here. Love talking about it.
Yeah, mate, thanks so much for your time. Mate, it's been great watching you grow BMT over the last 15 years. I think it was the first time that we sort of had a couple of beers in the city.
I think that was about 15 years, yeah, probably.
Yeah, and I hopefully when this current lockdown passes, we'll be able to enjoy a couple more.
Yeah, it's
beverages soon. Right, mate, well, stay safe. All the best for you and your family. And thanks so much for sharing that time with our membership.
Thank you. See you guys. All the best.
Great. Thanks, Matt.
See you, mate. Bye.
Thank you, everybody.
Take it easy.